All right, so we're starting up. Welcome everybody to the Chicago Ethereum Meetup. I'm Spencer, joined by Paul. We are two of the co-organizers of this meetup, and today we are extremely excited to have Pods Finance represented by Bobby and Rob, who are going to talk about their protocol and options on Ethereum. So without much further ado, I'll turn it over to them.
Thank you so much. Thank you, Spencer. Thank you, Paul, for putting this together and for inviting us. It's a great pleasure for us to be here tonight with you guys. And yeah, that's it. So I guess the idea here, it's like similar to what we do at DeFi Meetup Brazil. It's just like a general conversation. We're going to present a few slides to like help us during the talk. But the idea here is to get like personal and, and share what our ideas and why we're doing this. And I would love to you guys to like just raise your hand and ask questions at any time. We would love to like just start talking as up from now. And also thank you again, everyone that is here today. I'd love to get to know all a lot better. So by the end of this call, if you're interested in joining our community, just like please, you're super invited and welcome to our Discord channel, and yeah, shoot your questions, feedback, suggestions there. So I guess we could, I don't know, just start sharing our screen. Rob, can you do it there?
Yeah, I think I need permission.
I think I just changed it. Sorry about that.
It's okay. So, okay, are you guys seeing my screen?
Yep.
Yeah.
Oh.
But we're seeing it in like 2 slides. Is that a problem?
Yeah, so, right. I need to share the other monitor.
Okay, now it's perfect.
Okay, so should I start, Bobby?
Yeah, go ahead.
Yeah, so guys, I think it's always good to remember why we are all building this ecosystem. I know like each one of us has like personal reason to be here. I personally want to share why we as a Brazilians, one of our strong reasons to be here. And before diving into the product that I know that's the main reason that we are here, I want to tell you a little short story about a personal story that can help bringing you the context why we are building in this DeFi and all cryptocurrencies is so important for us. Okay, so the year was 1991, the year that I was born, and my mom, like she is like a very hard work person. She was the first person in my family to get a university degree, and like she worked since the 15 years old. And the year that she was pregnant, she was preparing to buy an apartment. And she had like a kind of investment that we called in Brazil overnight. It was a kind of special savings account. And basically our government like decided to confiscate and freeze all our accounts, especially for those who had investments in this overnight type of investment. And long story short, 30 years later, my mom is still waiting the money from the government. Like, and like, I think in this story and in this, like in the right, we can see the Brazilian inflation rate. And like, we are not talking here about like a very poor country, like, I don't know, in Africa or like Bolivia. We are talking like about Brazil, that's one of 10 biggest economies in the world since the 50s. Like we have a bigger economy than Canada, than Mexico. And even though like we had less than 15 years ago, 20 years ago, inflation rates higher than 40% a month. We had a year of, in the 90s, we had a month that our inflation rate was 100% a month. And even though we are better now, like in the past like 15 years, we had a good inflation rate of 10% a year, it's still like pretty high. So that's one of the reasons. So that's, for me, is the main reason that I joined crypto. I am a software engineer, a blockchain software engineer nowadays, working on smart contracts on Ethereum. I have a naval engineering background, actually, where I started to build like C++ for improving ships, routing ships for oil companies here in Brazil. But then I suddenly became a software developer. So I wanted to start this story with this slide, but we can take from here.
Yeah, that happened to my family as well. And I remember my mom tell us that she could only remove a certain amount per day that would allow her to buy a pizza or less. So that was a moment that all Brazilians remember. And I think that it's very important to us. And also another thing about Brazil is that we cannot hold dollars. We cannot hold US dollars in a bank account, for instance. So we can only hold a BRL. That means that, like, for many years, I think that since that thing started, we kind of forgot how it is to actually hold another currency. So Brazilians only interact with, like, the real mass of Brazilians only interact with USD when they're going to travel or something like that, when they want to buy something that is imported, that is normally very expensive. So I think that we kind of forget that we can actually have access to something different. And yeah, I think that this is one of the reasons why we think that crypto is so, in DeFi is so powerful. So I'm going to tell a little bit about also my story, like what am I doing here? And my story is a little different than Rob's because I started my career in traditional finance. So I worked at Barclays, at sales and trading desk, and then I worked at a hedge fund, and then like multifamily office, and then trading desk at Itaú BBA, which is the largest bank in Latin America. And I was there at the trading desk of this like super large investment bank, which is where I wanted to be the most because I don't know, I just love the craziness, the shouting and like the energy, and I love economy and like finance and stuff. So it was the job of my dreams. And then when I was there, I noticed that like people were working there like the same way for many, many years. And people that were in traditional finance before, like Disney and Alina, they probably can confirm that people are, at least in Brazil, I'm not correctly sure about if that's also in the US. I have a feeling that it is, but in Brazil for sure, the way that people work at traditional finance is like full of legacy systems. And you may need like 10 or 7 to 10 people to just close one ticket of a structured product or a swap or an option, because a bunch of people have to look it again and check it again and so on. And so when I was there, I got very frustrated about this. And I was like, you know what? I think this is going to change. I think there's technology available out there to change this, and I want to be part of that. So I left the bank in order to pursue whatever would be the technology that would change that. So I did that, and I ended up finding blockchain in 2017, late 2017. Well, so then, like, long story short, I started working with Rob and Guy and William in an American company called Mainframe. They were opening an office in Brazil, and they hired me to do that, to start the office in São Paulo. So then we started working there, and essentially in this timeline, they pivoted to DeFi in early 2019. And that's when all of us that we were in a very small office in Sao Paulo with a whiteboard. We had to understand and go over every other DeFi protocol that was coming out there. So we studied everything. We checked all the codes, understood things like as it was me as a finance background and the boys with like a super strong engineering background. In this little room, we could like just have a really amazing learning curve. So we ended up like super excited for doing things. So we started doing hackathons and like side projects. So that's when we did like the first hackathon that we participated in Brazil. We ended up doing some sort of issuing a zero coupon bond using STO of the company as collateral, which was interesting. And then right after that was when we did Oh My Die, which is what John asked us about in the beginning. So essentially, like in November last year, I don't know if you guys remember, but it was right before the multi-collateral DAI update. So the community was super divided between like, is DAI going to keep the peg or not? And we were like, you know what? We could build something to allow them to just, you know, bet against each other. So so we built this really cool first implementations of options in Ethereum. That is what we called Oh My DAI, which was like American put options for DAI USDC. And it was very fun, to be honest. It was really fun project. We loved doing it. Turns out that it was a lot harder to find users for a project that in the DeFi world where no one was talking about options yet, to actually like, you know, do the options there. It wasn't not audited as well. It was just like us doing something and putting it out live on mainnet, which looking back now, I'm glad no one used it. I'm glad nothing happened. Like, I think that was maybe a blessing. And then, well, I'm grateful for that. So we kind of left it aside for a while, and then we looked at it again during ETH Denver. Did anyone here went to ETH Denver as well this year? Yeah, oh yeah, you're right, Spencer. You were there. I didn't see you there, Paul. Oh, but it's good to see that you were there. Did you remember us presenting on the main stage by any chance?
Yeah, yeah.
Oh, really? Cool. Okay, so so it was super fun. We went to ETH Denver. We expanded Oh My DAI use case to Oh My DeFi, which was not only put options, but also call options. And it was just super fun. We loved it, and we want to go back to the next ETH Denver when the world is back, for sure. So after ETH Denver, we were just super sure that we wanted to keep working on this. And so we found our way out of the company we were working for, and we started Pods, right? So Pods is also kind of an extension from Oh My DeFi, where we're focusing a lot on put options, so we can build structured products on top of it. And we're gonna explain a little more about what that means. I think, Rob, I think you can change the slide. So here's what we're doing, right? We know that our code works very well for put options because we don't have admin keys, we don't have price oracles, and we don't have liquidation systems. And when you do a put option, of like, and you let's say that you're going to do a put option of BTC, wrapped BTC, right? So a person is going to have to, the option seller is going to have to lock collateral and is going to wrap this thing. I'm going to show it later again, but on this case of the price oracle, it doesn't make sense for the option buyer to exercise the option in case the price doesn't make sense for them to actually profit for it. So it's okay to not have a price oracle there, and it keeps being safe for both the option seller especially and the option buyer. So this is what we're doing. Like, we found a really interesting way of doing a code for a put option, and we're making it better. We're trying our best to make it better. By the way, I would love to talk to all the options traders here later at some point to know your insights about what do you think that makes options protocol better than, I don't know, maybe trading in traditional finance. I know that at this point it's hard to find a reason why you would think that DeFi options are better than traditional options. Maybe I don't know, a different asset that you wouldn't be able to do it in traditional finance. I know that that's not a very good barrier for entrance, but I would love to know more about other features as well. So, Rob, I think you can change now. So one thing that is interesting when you're looking at specifically DeFi options, and let's leave traditional options aside a little bit, is the cash flow. So when you're like, let's say that you are an option seller and you're a put option seller. So that means that you are interested in getting a premium for selling an option on a certain underlying asset. That also means that you should be aware and you should be interested in maybe buying the underlying asset at the strike price, because it could happen. So it's not the same as providing liquidity in Compound or Aave, because when you provide liquidity there, you just won't end up with the asset, right? It's just like with another asset, it's not going to happen. So when you're selling an option, it's different because you might really take on the risk of that other asset. But the interesting thing around when you compare the two, and if you are interested in having exposure to buying the underlying asset, is that you could use your funds to sell options and get the entire premium upfront when you compare it to like providing liquidity on a lending platform, that you would get like a variable interest rate with some maybe liquidity mining tokens in the middle. So one thing that we thought of in a way that how we could make DeFi options more attractive to option sellers is to actually put them together and bundle them in one thing. So this is what we call smart collateral. So when you're actually selling options and you have to lock your funds as collateral, you have to lock 100% of your funds because, you know, we still don't have a decentralized way of identity, or we're still getting better in under collateralized things. But right now, the way it works is 100%. And if you're going to have 100%, let's at least make this 100% very smart, right? So that would mean that you could use your funds from Aave or from Compound or from another lending platform in our protocol as providing collateral for issuing and selling your option. And in fact, you could even use this to like mine other liquidity mining tokens, you know? So when Aave has theirs running, you would be able to redeem them after selling the option. So that would also mean that you're going to get your underlying asset, if you end up being exercised, at a bigger discount than you would otherwise. So imagine that when you're selling an option, I think that this might be in the next slide. Rob, can you go another one? No, it's not. Maybe another one. Okay, yeah. So this is the user flow of selling an option, right? So you're going to lock your stable assets as collateral, and then you mint your pod puts, and then with those tokenized ERC20 options, you can just sell them anywhere. Right now, I know it's not very good. We're selling them in Uniswap and in Balancer pools, and we're going to change that for the future. I'd love to hear your ideas. But we tokenize this seller position, and then we sell it somewhere. And then whoever buys that token can just go back to our contract with that token plus the underlying asset and redeem the collateral that is inside. But now, if you think of that collateral that it's inside, and that collateral is a smart collateral, we can say that this collateral is like generating interest that is additional to the premium. Remember that the premium was paid up front. So this collateral is generating interest plus maybe a little yield from a liquidity mining program. And all of those, they are entitled to the option seller, not to the option buyer, because the option buyer is just going to get what was agreed upon, like in the beginning, right? Which is what he should be gaining. So if the exercise happens, what is going to happen is that the option seller is going to get back the underlying asset amount that is just what was agreed in the beginning, plus the interest that was gained over the period, and maybe the liquidity mining tokens. And if you add those things to the price of your underlying asset, it's like you're getting your underlying asset, as in you're buying your underlying asset at a bigger discount than you would if it was just a premium. So I think that was the option seller flow. If anyone has questions, just please, you can just jump in. I think, Rob, you can go to the next slide. And here is our sample, right? The option buyer side. You just go to the website or to another platform that you could find your options. Choose what is the option you want and pay the premium. Then you receive the option tokens, hold it until maturity, and then decide. Or you could decide at any moment, because at this point we're doing American. Looking into doing European in the future, would love to hear your thoughts. And then, well, essentially that's it. Like, you can decide to exercise or to let the option expire. And I think that was mainly it for the flow of the entire thing. So yeah, this is our if don't be shy. You're super nice. Come on. Sorry?
I have a question.
Go ahead.
So the strike price and the premium, is that you guys are defining these contracts that people participated in terms of the strike price, or how does that work?
So you're asking if we are putting the price in each strike price?
No, so like, are you coming up with the contracts, or like a user is doing like, I want to participate in the 300 strike for ETH, or I want to participate in the 400 strike for ETH? Where does the strike come from? How?
Okay. So right now, the way that we're doing is that we put strikes that could be similar to Deribit, so that users have some sort of comparison in prices. But it could be a pool in our Discord asking. It's just that we're not live on mainnet yet, so anything that we're doing is just valid for Coven testnet. But I think that in the future, when we're getting ready to go live on mainnet, it could definitely be asking to our community and checking what they want. But I'm curious, why do you ask?
It basically, if you have a limited set of strikes, I guess what I want to know is like, can I cover any strike I want, or there's only certain strikes that you're going to have available? Like, I might have an interest in, say, teeny puts, or I may have an interest in something that's closer to at the money. And I'm curious if both will be available.
I understand what you're saying. In fact, we did one thing that we call option builder for East Denver, but we decided not to do the option builder again for pods, because we thought that could narrow the liquidity too much for each option series. So that if we were to at least try to focus the initial liquidity into some certain option series, then that would work better.
Yeah, at least like the contract is going to be permissionless. Like, you can interact with our factory directly if you want and build your own series. But on our front end, we are going to narrow the liquidity.
Okay.
Yeah. Okay, so that was it. Like, for now, this is what our Coven testnet is looking like. We already changed a few things from this initial design, but the idea here is to try to abstract the idea of a put option. So you could either invest by selling an option or hedge by buying options. We're not sure if that's the best approach, and I also would love to hear your guys' thoughts around. Do you guys think that option sellers would be more comfortable with a pro trading view with more, I don't know, features? And whereas maybe the option buyer is not so interested in having this pro view. And yeah, I think that's it. Rob, do you want to add something to this part of the talk?
I'm muted. Yes. Do you think I should talk about the contract design now?
Yeah, you could definitely. If you want to also add something to what I said before, it's just feel free.
Yeah. Maybe we can try to show the demo later. And by the way, guys, like we on beta testing on Coven, you can subscribe on our landing page, and then we are going to send you an email so you can try and give your feedbacks on the beta, so you can like use the platform. And I just made this slide because like I think it's good to also understand the big picture of our contracts if you are interested. It's kind of not, it's not complicated. Like we have like a pod put contract that's basically the financial instrument where we can mint and wind, exercise and withdraw the 4 operations that you can do with options. We also have the WNA pod put, that's basically the same 4 operations but dealing with ETH and dealing with Aave tokens. For now, we are only doing with Aave because different from ERC20, there is a standard, there is a pattern. Interest-bearing tokens, we don't have yet like a ERC, I don't know, 70 that represents an interest-bearing token. So in order to implement an options-bearing collateral, we started with Aave because the architecture was easier. So that's the pod put. You have the factory contract that deploys a new pod put. Maybe in the future the governance will decide, so the protocol can be like fully decentralized. And then we have the exchange. It's kind of a wrapper where we can connect a provider, basically where you can buy and sell options. And under the hood, the exchange is connected to the provider. That could be, for now we have Uniswap and Balancer, but we are planning to the future having 0x and other like Kyber, I don't know, other or even 1inch. But it's the way that we did like connectors with our exchange, so it's very like flexible to like increase our contract size. So that's our contract design. If you have any questions, I can try to solve the technical.
I just want to make sure I follow. It's fully collateralized. That's how it works from the short side, meaning you lock up as if it went to 0 in terms of the amount of or the amount of collateral that you're using.
So it's fully collateralized based on the amount of the entire option. So like if you want to do one wrapped BTC, you have to lock, let's say, I don't know what BTC is now, it's like 10,000. So you have to lock 10,000 worth of like a USDC in order to, mint and sell one option of wrapped BTC.
I see.
I think we're approaching like the end of the content that we prepared, but we're like super up for questions and have a more open discussions. Rob, if you want to get more into the details of the code, this also like I think would be fine if people are interested in seeing that as well.
If it's easy to show the code, that'd be awesome.
Okay. So
no worries if that's complicated. You could always throw out a GitHub link or something.
I can walk through very
Yeah,
quickly.
that's the Chicago Ethereum way. We wanna see the code.
Yeah, talk is cheap.
That's great.
Okay, so uh, that's our repo.
Well, we can't see anything. Where is it? I think you're sharing in a different screen.
Yeah, true.
How many people have that same background on their Mac right now? I know I do.
Yep.
Okay, so this is our repo. By the way, we use it Buildler in our stack. And in the contract, by the way, if you guys want to have like a good inspiration of building scripts like tasks on Buildler, we build like very good tasks here for Balancer, Uniswap V1, like deploying a new series, deploying a new exchange, like these are all tasks on Buildler. So basically, we split it in tasks like add liquidity, create exchange, finalizing the pool balancer is very easy if you want to learn from here. But going to the contracts, so as I said, we have the pod put, A pod put, and W pod put. Basically, is the financial instrument that you can mint, exchange, withdraw, and exercise. So our contracts is also, we have the documentation on the website, and then the code is very documented also. So explaining exactly what is happening.
Does the A stand for American?
No, A is the AVE
Ah, got it.
as collateral. Yeah, A pod put is. Yeah, so basically, the way, in order, so the hard thing about A pod put, for example, is how to track the interest that the option seller is earning when he's locking the collateral. So in order to do that, we did like a similar way that Uniswap did. Like you like kind of take a snapshot in time, and we store, instead of storing like the locked balance, we store like the locked weighted balance. Like, so taking account how part of the pool you won, basically taking account how much interest you earned. So that way we can, like, if you are since the beginning of the pool, you are going to earn more interest. In that way we can avoid like a person going the last day before the option expiration, joins the pool and earns proportional to the others. So okay, so here you can mint an option in behalf of someone. So I can mint options for Bobby. So in that way is more flexible, our contract. And you call this function saying how many options you want to mint. And then we calculated the strike to transfer, like basically on calculating the strike price. And here we calculated your weighted balance and store. So here's how I said the unwind function. If I am an option seller and I want to leave my position before the expiration, I call this function saying how many options I want to unwind. For sure, like you cannot unwind more than you minted in the beginning. Here we have the withdraw. And that's basically the same as, that's I think worth mentioning. For example, imagine I'm an option seller, I locked my collateral, and different from, for example, open, they're like you exercise individually. Like when you exercise, you need to choose which vault are you exercising. In our case, we split it among all the option sellers. So by the time that you want to withdraw your funds, like after the expiration date, when you withdraw the fund, you're going to withdraw, if the pool have like half of underlying asset and half of the strike asset that was not exercised, the option seller is going to withdraw proportionally underlying and strike. That was an approach to avoid like race conditions and favor like option sellers that went first and removed like all the strike asset in the beginning, and for the latest like only rest the underlying asset.
Yeah, that's really interesting, because I know that with open, there's this interesting dynamic where like if the price so for OETH, their ETH options, which they don't have anymore, but what they used to have before they had their issues, with OETH, if the ETH price dropped below the strike price at any point, you would sort of like, if you were an option seller, you sort of just like hoping that whoever might be exercising the options like wasn't going to choose your vault. And it's like introduces this weird uncertainty that like in a sense like is kind of good in the way that maybe yours won't get exercised, but could then introduce like other strange incentives or just stuff that you like wouldn't normally think about in a protocol like that.
Yeah.
So I think it's kind of nice that you sort of just avoid that extra layer of uncertainty.
Yeah, exactly. So in our mind, like becomes more fair for the option sellers. Yeah, and in that sense also, I think it's important. By the way, like as I said here, that's the financial instrument, and then we have the option exchange and the exchange providers, as we said, like the exchange that we are connecting to in order to buy and sell. So here we have Uniswap V1 and Balancer, still work in progress in the others. And also security is one top priority. So if you want to take a look also in our test scenarios, like we have more like than 200 with unit testing, like stressing and fusing all the scenarios. So I think if you have a good inspiration test, like we basically test scenarios like WBTC, USDC, WETH, USDC, different numbers of decimals, different numbers of strike price decimals, this kind of stuff. And basically I think is that, I don't know if you guys want more deeply, something more deeply than that, I can keep going. Well, you can ask something. I think there's something in the chat.
So I have one.
Go ahead, sorry. I'd be curious to see the factory, so that we could set our own strikes, for example.
Yeah, sorry, that was your initial question and I forgot to show the factory. Okay, yeah, so factory, what is important is you have two different factories, one for interest-bearing tokens, the A option factory, and one for normal tokens. So here inside the factory, you have, I entered the exchange. Here inside the factory, you have two functions. One is create option, and the other one is create if options. So if your underlying asset is going to be if, you have to call this function. Otherwise, you can call this function. And basically, we have these 6 parameters: the name of the option, the symbol, the option type, 0 for put, 1 for calls, the address of the underlying asset, for example, WBTC, the address of the strike asset, for example, USDC, the strike price in units of strike assets. So strike price is the same numbers of decimals of the strike assets. It's an example here in the documentation, or you can find us on the Discord. And the expiration date in block numbers. So we are not doing expiration date in timestamp for now. It's on the roadmap. So here you need to do like a little calculation. And basically that's the parameters to build, to deploy a new pod put contract. And then you have 4 variations: the pod put, the W pod put, the A pod put, and the WA pod put.
And what is the W pod put?
If is the same. Yeah, so
is it wrapped ETH? Okay.
Wrapped with, yeah.
Got it.
It's our, yeah, we work with WIF in order to avoid. So we use this different approach, so we can, instead of like in the same contract, if do something, we have like a WIF approach here.
So the create ETH option is just wrapping the ETH first and then using the same internal?
Yeah, basically, actually, yes, let me show you. In our, what we do in the W pod put, we override, we have like an exercise if, and then we override the withdraw, and then we do what you said, like basically before withdrawing, we call the WIF function, and here before exercising, we call the deposit WIF function.
Yeah, okay, cool.
Yeah, for the end user, he don't need to have WIF. Like he can call the contract only if with, and we do the operation.
If you call that factory for a call, and let's say you're selling the option, what do you lock for collateral on a short call?
Yeah, for now we are not doing calls. We don't recommend, because it's not like capital efficient, because we are doing the opposite with calls. Like instead of locking the strike asset, like for instance USDC, you are going to lock like WBTC or ETH, like since the call is the option to buy. So you are going to store the underlying, like you're going to store WBTC or ETH in our contract, and in order someone in the future going to buy.
And as you can imagine, it's not very interesting to do call options in that situation without a price oracle in the middle, because someone could just go and, you know, buy options there and exercise even though the price is not, you know. So that would require from us a change in the smart contract to add the price oracle.
Yeah, or we can believe, like if we believe in market forces, the premium paid for the option in the pool in the market is going to be like at least the difference. And
always, yeah, at least should at least always be the difference between spot price and strike price.
Thanks.
We had a couple questions in the chat. Tessa asked, why are you using Aave? It's pretty expensive gas-wise, and there's no token earn like on Compound.
Do you want to go, or should I go?
Go ahead.
Yeah, so we actually, to be honest, we started with Aave first. Reason is because it was easier. As I said, like interest-bearing tokens, we don't have a standard yet, like ERC20. So the way that Compound, the way that Aave returns interest is easier to handle. And so technical reason was the first one. Second reason, when we started, was before Comp, and we also, at least we are going to be the first ones when Aave launched the liquidity mining program. And another reason was we were in the hackathon, and Aave had a grant, and we just applied for the Aave grant with this. So 3 reasons. But we plan to have like, actually, one of the plans is to have like a multiple approach for the collateral. So it could be as a stable asset could be, I don't know, curve, like pool, something like that. Also, are you whitelisted on Balancer to earn rewards? Not yet. Like, we are working on that. We are talking. By the way, Balancer founder Fernando, he's also Brazilian, so we have good contact with him.
So you mentioned a couple times like liquidity mining and sort of the idea of, so I guess you could sort of earn interest with Aave, or you could also have liquidity mining as like a part of the underlying asset. I guess one thing, I'm sorry.
I don't know if I follow. You said liquidity mining as part of the underlying asset?
That's probably the wrong phrasing. So you can support, so with Aave, you can support earning interest. And I think you've also mentioned, maybe I misheard, but you've also mentioned the ability to also earn liquidity mining tokens on the collateral asset, right? How do you figure out how much of that, like if you're, well, so the collateral asset that you have is in your own, it's in your own vault, is that right? Like in a vault, like dedicated to you?
Yes.
Okay, so I guess I've answered my own question. So that vault is the one that earns the liquidity mining, and then you have full control over that vault. Okay.
Yeah, and we keep tracking of we just need to keep track, like in the moment in time that the user joined, how much of, for instance, Aave token the user like joined, so we can do like the math to by the moment that the user is withdrawing, we can calculate how tokens, liquidity tokens he deserves.
Actually, can you talk a little bit more about that? How are you doing that calculation? I'm curious to know.
Yeah, so what we are doing is like similar to Uniswap, when you like join the pool and you like kind of earns some part of the pool, and then when the next person joins the pool, he like do the calculation with like how much do you earn of that pool. Is the similar approach. So let me show you. Basically, you can check later here the math inside the mint function on the output. This is as an example. So basically what I do is checking the contract is the owner, right? So basically the contract is going to earn either interest from our tokens or the liquidity mined tokens. So by the moment that a user is joining the pool, I can check how much tokens the contract have owned, and then I can give the like fair share for that new user by the moment that he joined the pool.
Okay.
So basically the math, like here's the numerator and denominator. What I do is checking the underlying reserves, or in the case of liquidity tokens, I'm going to check the liquidity tokens reserves and then doing like a, actually, I think I have also a better explanation.
Yeah, there's that presentation that we used, remember?
Yeah, I just have
as we're a super remote team as well, like we use PowerPoint presentations to sometimes enlighten each other's ideas. So Rob did once this math in a PowerPoint for us, explaining each step. And I was just thinking about that situation.
I think now it's going to be very clear how we calculate. Okay, so I will simulate like a user flow here, and it's going to be, I think, very clear how we do the calculations. So basically, I am the Alice, this address, I want to mint one pod put. And okay, I transfer me the A collateral. You need to approve the contract first. And then we are going to have like 200 as reserves in our option contract. And then the user gets one pod put, one pod token, and then they can sell in one of our exchanges like Uniswap, Balancer, or 0x. So that's what we store in the contract. This is kind of the snapshot, like the sender, like the weighted balancer, the total locked, this total lock normalized is basically the sum of all weighted balances, and this is the reserve in this moment of time of AUSDC. So okay, so imagine now a second user is going to mint another option, but now what happened? Similar to liquidity tokens, what happened to AUSDC is the contract itself earned $10 in interest. So now, instead of when a user is going to mint a new option, I need to calculate how much he deserves, but the pie increased the size. So what I do this math here, normalized balancer. That here's the magic in order to store how much the user deserves. Basically, it's like a weighted math considering the reserve in the moment right now. So for instance, if a user wants to mint 0.4 pod puts and he wants to lock 8 AUSDC, I will not store like the 80 similar to what I did for the first user. I'm going to store 76.1 something. In that way, I can, it's kind of the share of the pool that these guys, this guy earn comparing to the full reserves in the moment. So now instead of storing 80, I'm storing 76, and that's the new total locked normalized. Okay, so by the moment that the user is going to withdraw, imagine these 290 went to 315, like earned interest or liquidity tokens. Now to see how much the user deserves, I do like basically the weighted average. So I get the weighted balance that I stored for the user. I multiply.
Rob, but there's someone asking, so they send you 80, but you keep the difference between 80 and 75. So I don't know if it was clear the weighted.
So they send you, but you keep the difference. No, I don't keep the difference. I keep the 76 is what I store in my contract.
You only transfer the 76, even though they said originally they would transfer 80. Yeah,
like they send me 80. The contract reserve is going to increase by 80. So in order, if I wanna check how much like the contract have is like his balance, I just like say like balance of the ERC20. So I have tracked the full amount of the contract, but also I track the weighted balance of the user. So I'm tracking two different balances here. So by the moment that the user is going to withdraw, imagine that 290 became 315, more interest accrued. And then what I was saying is you do the maths with the weighted average. So 76 times the full reserves of the contract divided by the total locked. And then this user remembered he deposits like 80, and now he like get 80 back plus 6.8. That's the interest that he deserves. So that same logic works for liquidity tokens, but instead of reserves of a USDC, you just like change here for reserves of the liquidity token or whatever. So basically is that. And then we have like a scenario. This is a scenario that no, you don't have like exercise in the middle. We can like go further and analyze like a scenario where you have like two different reserves. So imagine what I was saying about opening that is different here. Like we need to do the maths by the time that the user withdraw. So he gets a share of the collateral and a share of the underlying asset, and it's basically the same logic.
One question I have is, are your users mostly developers or other smart contracts or people using a web app or bots or what do you envision most of your users will be on mainnet, I guess?
Yeah, I think like we are going to have like multiple strategies. For example, like we need to connect the channel of the distribution for new users. Probably is going to be Argent, Pillar, like a lot of wallets that the users can interact easily. But also we want to be very developer approach, so other protocols can easily build on top of us. So I think maybe what do you think?
Yeah, I agree. I think that I would say that there could be more than one approach to each side. So like option sellers are 80% different from option buyers. Like buyers are generally at least in DeFi, buyers of options and buyers of put options in DeFi, I feel that are very different. And also from the users that I've been talking to right now. And so I think that it's going to be totally fine to have a different approach to serve each one of them in the best way that we could for each one. So probably the buyer of put options will try to interact with that, like buying hedge for their position in a wallet, for instance, directly in connections such as those. But as far as selling options go, it could be another type of user, someone more sophisticated that understands that selling an option is different than providing liquidity, and so on and so forth. So we're gonna do our best to do all the integrations that we can, and as we would also love to hear from you guys. Where would you like to see us if you were to be a user? And I think we still have our front end where people can just go and interact with the contracts right from there.
Yeah, I got a question. So you're are you gaining interest dependent on how many shares you've already put in? Is that kind of how this works? Or you're getting your total values? There's like a little bit of money tacked on for every time you put in more money.
Yeah.
That's the gist of it.
Yeah, it's like a measure of the not only the amount but also the time that the amount like was waiting.
Okay. Okay.
Do you want to share about it?
Yeah, no, yeah, it was just if you guys like as I said before, like if you want to interact with our beta, here is the option sellers screen where in the right you can check the options informations, like the type of the options, the expiration date, the collateral, the underlying, the APR is Coven, so it's fakey, and the market premium by the moment. So here you just choose how many strike asset are you willing to lock. We show you, we make clear how much like underlying you are willing to buy in case you are exercised, and then you can choose in which currency you want to receive your premium, upfront premium, and then you just click sell options, and let's test here. Yeah, first you needed to approve. Okay.
And if you don't have faucet yet, you could just click on get faucet so you can interact
Yeah.
with the things easier.
Yeah, true. You, in order to test on Coven, like here, you get like a little bit of each token, Aave token, buy token. And then after minting, so I went to the invest page, I selected the option series that I wanted to mint, to lock and sell and get the premium up front. After that, I can check my position in my dashboard screen. So we're still working on that, but basically you can see how, like which series, how many locked, and I can click here. And but if the options expired, I can withdraw. If not, I can unwind certain position. We only have like withdrawing options here. And that's the invest page. We also have like the hedging page where you can buy, exercise, or resell your options. And here is even easier, like you just choose the option series that you want to hedge, the premium that you are going to pay, the currency that you want to pay with, and then you choose like which one you want to sell, and you need to approve first and sell after. So if you want to try, you can go to pods.finance and sign in for the beta here. And we are going to send some instructions. And we really want to hear your feedbacks about the UX, about the pricing, about the option series that you are most willing to have.
I'm running it in Firefox, and if you go directly to the invest page, it just kind of hangs. It says it has the all options, and then it just has this like bar that's going across the screen. I'm running.
Did you connect with MetaMask?
On Coven, are you in Coven network?
Oh, is that a VPN? Yeah. Well, I'm just saying, do you have to log in to get a session state first, or is it just kind of hang?
Yeah, we're still working on that.
Okay.
So I have one question, but I'll hold myself off for a second. If anybody has any other thoughts or questions before I go, please speak up if you have one.
I would like to ask Alex and Alina about like your ideas or perceptions, and from also your previous experience, like what do you think that would be most appealing to DeFi options, and how could we improve?
Well, I think one of the hardest things about options in general is education. So you kind of have a choice to, I don't want to speak too strongly or confidently, but I would suggest that you have a choice to target smart money or retail money. No, not to be too derogatory towards retail money, but the more institutional style players will, like John was mentioning earlier, want to have very sophisticated capabilities to create very educated hedges with very tailored strike prices, which may not be best for the retail front end, for example, unless you have a way to educate more less institutional.
Totally agree. Question around the institutional is that do you see any institutional using DeFi options at this point? And if you do, like how do you think that they are doing it? Like so far the conversations I had was around like, oh, we can't really touch DeFi yet as far as a regulation perspective go.
Yeah, I think a large portion, and this has been true for a while, of institutions are intimidated, or their legal departments are intimidated by DeFi in general, because they don't like the idea of being tied potentially to money that they can't guarantee was not, sent in by terrorists. AML money, basically. I know that this is somewhat anecdotal because I'm not really in contact with a ton of institutions, but I know some people who work in the space, and there is an increasing interest in DeFi for institutions, but there are still, the vast majority are avoiding it. I think it's mostly the smaller groups and also entities that have been created specifically to trade DeFi or as crypto funds. Those are the entities that are going to be the most interested in trading options.
Okay. Thank you.
We've got another question from Tessa. Can you create combination orders like call put spreads or strangles or something else?
We were doing that in ETH Denver. We did a straddle for ETH, and essentially it was just a very simple combination of buying calls and buying puts. But at this point, we are not doing it, but this is something super interesting that we would definitely look into in the future, like for sure. If you could share what you would like to use, it would be fun.
So the question I had is, I'm not sure if you're familiar with Potions Finance.
Yeah, we are. Jordy is great.
Yeah, so I certainly do not understand all of what they're doing, but my understanding, and tell me if I'm off base here, but my understanding is that they are attempting to create sort of a single liquidity pool version that will like create, that has the ability to create sort of the like any series of options that you may want.
I understood that too.
And I think it's like a super interesting approach, or at least sort of objective. I think there's always a trade-off in everything, and I think the trade-off that they're facing is that there's more uncertainty up front in the price you're going to pay at the end for your option, because I think what they're doing is they're trying to calculate the Black-Scholes price over the course of the life of the option that you have, and then you pay the price at the end. I am very much an amateur understander of options, so if anybody has a like better understanding of what they're doing, please correct me. But I think that's it. Like, so I guess my question is a very open-ended one, or a general one, of how should we be thinking, or how should you be thinking, or anybody be thinking about the trade-off between sort of this like concrete understanding of what you're going to be paying up front versus less understanding or less certainty and like a broader range of possibilities of what you can do, or the type of series you can create by yourself.
Yeah, of course. So to be honest, I don't know how the project's changed over the time from Hack Money to now, and I am certain that it did, because Jordi told me that something's changed. But what I remember from Hack Money was that they were creating something that resembled an option, but is still very different, because you don't pay the premium upfront. You instead pay the premium in the expiry date. And with that, they would be able to calculate the correct amount of premium for each side, both the option seller and the buyer. And back then during Hack Money, I questioned them as well. Like, I don't really know how users would use this instrument, like, because I don't remember of an instrument that is like that in traditional finance, like, whereas both of the option seller and the option buyer has to provide collateral, because you don't really know how much is going to be the premium. So I don't know. I think I would love to hear more about other folks that were in traditional finance as well, to know if they remember of something that would be interesting around this new version of using options. I think it's always valid to, man, honestly, like, try using options in different ways that weren't used before. So I would be curious to see how are they using it, and how option sellers and also buyers are using it. My understanding of options trading was that risk is there, and risk is volatility is an asset class. So people actually want to, sell options because they want to get in the volatility of a certain asset, because they have a certain belief around this volatility, and they price that up front. So I think I would love to know more about the use case of the user that would be interested in pricing it afterwards. And I asked them that same thing. You guys have any other comments? And in fact, I think maybe, Spencer, we could do one day a panel talking about DeFi options. That would be really interesting.
Yeah, if we could get, and I guess this is a note for Paul, if we can get potions and open and bring back pods, that'd be fun to have a full panel spanning the whole range of option protocols. That'd be pretty cool.
Yeah, sounds good.
Yeah, it would be really fun. And also, if we could get more, I don't know, maybe conversation. Mona is really, really smart, and she worked in many years in traditional finance. So it would be really nice to, like, I don't know, have her in the panel maybe as well. to get her perspective on, especially on market making for options. So I think it would be great.
That'd be a great candidate for, so a couple months ago, we had a joint meetup with the Buenos Aires Ethereum community. And we had both Balancer and Uniswap. And we did kind of, they each presented, and then we had a panel, sort of competing visions maybe of automated market making. So maybe we could do a similar type of thing. We could partner with somebody else, another geographical community, and bring in a few different teams. I think that'd be great.
Okay, it would be great, but let's not do it a competition. It could be collaborative.
I chose the wrong word, but differing ideas about how to do the same or a similar thing. How about that?
Of course, yeah. That's great.
Okay, so typically what we like to do is take a bit, like a brief break, and then everybody can go get a drink of their choice, whether that's alcoholic or non-alcoholic, and come back and just hang out, and we can sort of open things up to whatever topics we want to talk about. We could go even deeper on options, on pods, on whatever, or any other kind of topic. So whoever would like to stick around for that, you are absolutely more than welcome. This is one of my favorite parts of our meetups, is just shooting the shit. So maybe we'll take a 5-minute break, and then we'll come back to do that.
Yeah, that was super interesting. Thanks so much for the presentation.
Yeah,
Thank you,
thanks
guys.
so much.